Hey everyone, Ryan Bolton here, and I am a mortgage nerd. I'm licensed in the states of Utah and Nevada. I work with Patriot Home Mortgage. If you need help with a mortgage in other states, we do have other loan officers here in the company that are licensed in many different states. So if you have any questions or need help with real estate financing, check out my website, ryanbolton.com. I can either help you or direct you to the person that can, but love an opportunity to work with you. So I try to keep these Q&A videos down to about 20 minutes or so. So let's see how many we can answer today. And if you have any questions or comments or topics for a future video, please comment in the video and I'll get to those in a future video. So let's go ahead and just see how many questions we can get right and how many we can answer today. So let's jump right into it. It says, what is the best way? What is the best and affordable way to buy a second home for rental in the Philippines, assuming a mortgage, buying a condo, or buying a house? So it doesn't matter if it's in the Philippines or wherever else it is. You're going to have to qualify for your existing debts with that new payment as well. But when you say second home for rental, that is not a second home anymore. A second home is where you use it kind of maybe seasonally, or you live there part of the year and then you just have it vacant the rest of the year. As soon as it is a rental, it's a different type of financing. So it depends on if it's nightly rental, long-term rental, that kind of thing. But you do have to qualify essentially for your existing mortgage, car loan, visa, student loans, whatever debts you have, along with the new mortgage as well is what you'll have to qualify. As soon as you start using rental income to qualify, it's not a second home anymore. And the reason why that's crucial is there's really three types of occupancy. You're going to have primary residence, second home, and investment property. They all have different guidelines, different rates, different down payment requirements. And occupancy fraud is the number one fraud in our industry. People claiming it's a primary residence when really it's a second home or a rental or something that's different. So you want to be careful on how you classify the property based on how you're actually going to use the property. So people kind of confuse second home and rental property a lot. And so you just want to be careful how you do it. But the best way to afford it is you're just going to have enough income to offset both, or you are going to have to claim some sort of rental income on the new property, which then changes the rates and terms. All right, let's see what other questions we have here. What are the differences between an FHA mortgage and a standard mortgage in terms of interest rates, down payment requirements, etc.? So FHA doesn't actually loan the money. They set the guidelines. They're basically a mortgage insurance company in a lot of ways. They set the guidelines that if we follow and something goes wrong with the loan, their insurance kicks in. But FHA typically allows for a little lower credit scores. It requires 3.5% down instead of the typical 5% down on a conventional loan. Now, even conventional loans have programs that only require 3% down, and there's even programs that are 100% financing. So these are going to be general answers to this question, but FHA is going to be typically, I've seen a little better interest rate, but usually a little higher mortgage insurance depending on the credit score. So I'm sitting down with a client, depending on their down payment, we'll kind of look at both options and say, okay, well, it's a little more money down, but it is a cheaper payment on conventional because of your credit scores. Or maybe they have a longer job history or not a first time home buyer and don't need like that FHA type loan. But FHA is not just for first time home buyers either. So they just have additional guidelines to help those people that haven't owned a home before, because there is higher risk with somebody who hasn't owned a home before. And so the insurance has to kind of offset that. But if you have a higher credit score and have the extra money down, conventional is usually a better way to go because it's just going to be cheaper per month. Because FHA's mortgage insurance is kind of a flat fee, regardless if you're a 620 credit score or a 900 credit score, you're still getting the same mortgage insurance. So when you have a higher score, that mortgage insurance can be cheaper, even if the rate's a little higher sometimes on conventional than FHA. I mean, they change. Sometimes it's the other way around, but most cases, I would say VA, FHA, they do have lower interest rates, but they usually have that little higher mortgage insurance kind of built into their loan. Down payment requirements, we talked about it. There is Home Ready and Home Possible. These are programs with Fannie and Freddie that require 3% down. And they also have a little cheaper mortgage insurance, again, depending on the credit score. It's a way to kind of compete, I guess, if you will, or allow a little more flexibility to kind of compete with FHA loans. But really, it's kind of most of the time you're going to see a 5% down where FHA is 3.5%. One other thing on the mortgage insurance with FHA, you can't get rid of the mortgage insurance unless you sell or refinance the home, unless you put 10% down when you first buy it. But again, most people putting 10% down, they're not using an FHA loan. They're going to go with a conventional loan. But in typically FHA's mortgage insurance, you cannot drop off until you sell or refinance that loan. Where with conventional, you can. You have to keep it typically at least 5 years, but don't have to keep it more than 10. Now, there's going to be differences. You got to check with the mortgage insurance companies. They all have a little different guidelines on how you can drop it off, but at least there is a way to get rid of it without a full refinance. But I'd say most of the time, a huge percentage of people that can drop off the mortgage insurance are going to refinance or sell before they naturally drop off the mortgage insurance. Here's something else to consider. You can actually get rid of the monthly mortgage insurance by paying a one-time fee. So instead of paying that monthly fee every single month, you can prepay it and buy it out completely. And I found when I've been doing the math, it's usually around 3 years worth of the premium. So if you're going to keep the home that long, not going to refinance, not going to sell, you may look at the option of buying out the mortgage insurance. You can't do that with FHA, but you can with conventional. So I've showed clients many times and say, well, instead of putting the extra money down, let's get rid of the mortgage insurance, which is cheaper, and get you the better rates and things like that by still having that mortgage insurance on there. So that's something else that's a little bit different. But that's part of our jobs as loan officers, is sit down with the client and say, okay, which of these best fits the client's credit, income, assets, down payment, whatever it might be. And that's really how we help clients determine which loan is better. But those are some of the differences between a standard kind of FHA loan and a standard conventional loan. What other questions do we have? When do you start paying on a mortgage when you're building your own home? Well, it depends on how you finance the building of the home. If you've just been paying cash, you really don't have a mortgage. So you don't pay on a mortgage until you either roll that construction loan into a permanent loan or until you pay yourself back. So I'm assuming that this may be may already have a construction loan. I'm just going to have to make that assumption with this. A lot of times construction loans will either have a monthly payment or they'll have what's called an interest reserve. So they'll actually build in, as part of the available funds, the interest as you go along. Because with construction loans, you may have, say, a $500,000 construction loan. You don't pay interest until you start drawing against it. So you'll typically see maybe a draw for the land or the plans, the permits, kind of the initial draw. Then you'll see a draw maybe after footings or foundation, maybe after framing, roof. You'll kind of see these stages. So the balance kind of keeps creeping up. So you'll be paying kind of a different interest amount as you borrow the money. And a lot of times it's just built into an interest reserve as part of the loan. So uh, it depends on how you finance the build of this home. But if you're just paying cash, you really don't have a mortgage. Then once the home is done, you either do a refinance that refinances the construction loan into a permanent loan, which is called a two-time close, one for the construction, one for the permanent, or a one-time close. Once it's done, it just rolls automatically into the long-term loan. Then it's usually about 30 to 60 days later is when the first payment on the permanent loan starts to kick in. So I hope that was helpful. Again, if you have any questions, comments, concerns, please comment them below. We'll get to them in a future video, but love to have a dialogue with you with how this stuff works. All right, let's go to this one real quick. Is it possible to purchase a home with bad credit, but a good income and stable employment with also no past bankruptcy? So they put in italics here, no past bankruptcy. So I often tell people, yes, you can buy, if somebody's willing to loan anybody money. It depends on how much money down you have. It does depend on debt ratio. It does depend on those types of things. But I always tell people, why is the credit bad? What can we do to get the credit better so you're getting a better interest rate? Sure, somebody's going to loan you money. Here's your loan at 20%. Great. Or let's work on the credit to try to get you more into an FHA or into a conventional loan, or find out kind of why the credit is bad. If the income is good and the job employment's stable, then maybe that's the next step, is to recover from whatever caused the bad credit. Now, it could be medical. It can be other reasons. It's not all just people being irresponsible with their debts. There's all kinds of reasons why people have bad credit. But knowing what it is and how to fix it is worth the effort, instead of just taking whatever loan you can get. I'm amazed with 90 days of working with clients, I've been able to get their scores up to where they can get closer to a conventional loan or even an FHA loan. It doesn't take a crazy score. You don't need a 900 credit score to buy a house. You can go down to a 580 credit score if you have enough down payment, but 620, 660 is not crazy hard to get to if you can start building positive and start working on the negative. So this question pops up a ton. Can I get a mortgage with bad credit? The answer is yes, but it may not be a loan you want. Work on the credit first. And I can help you with that, whether you use me for a loan or not. I'm totally fine with helping people get their credit on track and doing a free review. or talk with a loan officer in your area and say, hey, I need to get a plan here. I need to pull my credit, see where I'm really at, really get my 3 credit scores, and get some advice on what to pay down and what to do to build it, and get yourself on a path to buying a house. I'm amazed at what I can do in 60 days. Give me 6 months even, and it's a world of difference. I've worked with clients for a year to get their scores where they need to, or their income and assets and things like that. It's part of the job. And it's a fun part of the job. Problem solving and helping people into a home ownership is a great joy of why I still do this. It's just great to help clients buy a house. And if you need some help with the credit, there's always a place to start. And the sooner you get started, the sooner you're going to be in home ownership. What I see too many people do is they will have bad credit. They kind of get their situation on track for 1 or 2 months, better job, better income, whatever it is. Then they try to go buy a house because their lease is going to expire, but they haven't done anything to really kind of fix the previous stuff. You want to start doing that sooner than later. The more time you have, the cheaper it's going to be, the better you're going to get it fixed. And it affects everything from the home loan to the insurance to jobs to car loans to everything's tied to credit. So fixing it is only a smart thing to do. All right, got on the soapbox there for a little bit, but I hope you can see the passion of how much it just takes time. So get started early. All right, let's see how we're doing on time. I try to keep these to about 20 minutes. Looks like we're a little over 11, so we can go a couple more questions here. Let's see. How do I find a reputable professional credit repair service in my area? A lot of them are done online. Lexington Law is a really popular one if you search online. There's a company in Utah and Bountiful that's called Credit Unlimited. I really like their service. I refer them a lot. They're very reasonable on their fees. Some of these companies charge a lot. I would say that's probably the number one indication that there might be something fishy going on is just the cost. It should not be thousands of dollars to fix the credit. And just how they walk you through the process is really important. One other thing to be aware of is people will say credit repair or debt consolidation service. That's a little different than just paying off debts. I mean, but if you're using a service to help you pay off the debts, a lot of ways that's basically a Chapter 13 bankruptcy, especially the way they report and how it can affect your credit. So just be aware there's kind of a difference between credit report repair and debt services or debt counseling. So just be aware of some of those terms and just go into it eyes wide open. And I always tell people when you go in and meet with them, don't do anything yet. Step away, get some other opinions. Just make sure it's not something where you're getting roped into some sort of debt consolidation service. They're great. They're great if you know what you're getting into, and just realize it's really a Chapter 13 bankruptcy. It's using similar laws, it's using similar provisions without literally going in front of the judge, but it's using very similar laws and it affects the credit almost in the same way. So just be careful with debt consolidation services. But as far as credit report repair, I recommend Lexington Law. They've always done a good job for my clients nationwide. Here in Utah, and I don't know if they do other states. I'm sure they do. It's called Credit Unlimited. Heather's great over there. I highly recommend Credit Unlimited. Let's go answer a couple more questions here real quick. Let's see. Why would someone get a mortgage on a home that's free and clear? So a mortgage is a loan against a house. It's collateral for a loan. So even if the house is free and clear, maybe somebody wants to pay off other debts. Maybe they want to buy another house. Maybe they want to do home improvements. So they're just tapping into that equity that's sitting there, because the only way you get to the equity is either selling or doing a new mortgage. So sometimes it makes more sense to get that mortgage than it is to have a bunch of different credit cards or car loans or whatever it might be. And a lot of times people have been sitting on a lot of money sitting there, especially if the house is free and clear. So why not pull that money out and find other ways to invest it or pay off other debts? I mean, I've seen people that have free and clear all this equity in the world, and yet they have all these 20% credit cards. And I'm like, there might be a better way to pay for this stuff, especially if they haven't been able to pay down a $20,000 or $30,000 credit card. Now, there's always a balance between using the mortgage and then all of a sudden racking up the credit cards again. So there's some discipline on how you're handling your finances, but you don't have to have a property free and clear to put a mortgage on it. And there's a lot of reasons why people want to get to that cash. So let's say you also have a mortgage, you can replace it with a new mortgage. That's called a refinance. So this is where maybe you get better rates and terms or drop off mortgage insurance or pull out some extra money to pay off other debts. That's usually the most common reason for refinancing. But you don't have to have the property free and clear, and it's just another loan. So if the loan makes more sense and pays off debts, that's why most people will do it in that case. So it's like, okay, once it's paid off, I guess this guy's maybe thinking, why would you then all of a sudden go back into debt on the house? Well, if you have other debt, if you can get a better rate of return, if you can maybe remodel the house, maybe it needs a bunch of remodeling, maybe you're going to go buy 2 or 3 more homes. If you got a bunch of equity sitting there, go buy a couple homes with it. So it's just leverage. That's really what a mortgage would be in that case when it's free and clear. All right, how we doing on time? 15 minutes or so. Let's see if we can answer a couple more questions for everybody. And again, if you have any questions, comments, please post them below and I'll get to those in a future video. Are you a potential home buyer? Are you a potential home buyer who finds it hard to get a mortgage because of affordability issues? I guess, yeah, I'm sure that I think affordability has definitely gone down in the sense that what was a 4% rate is now a 7% rate or whatever it is. And the fact that the home prices have still gone up. But I still think it's still more affordable to buy a home. You may just have to be a little more selective, may have to move a little further out of town to get into the first one. What I'm also seeing is a lot of people are teaming up as co-signers. So brothers and sisters or roommates in college or whatever are kind of teaming up on that first home to get it maybe closer into town, make it a little bit more affordable on the first house. Then when they go to sell, maybe one of them gets bought out or cashes the other person out. They both just sell it, split the equity, and move on to the next house. So affordability is always going to be an issue. But I look at the stability of a mortgage loan. With rent, it could go up. When was the last time your rent went? Anybody that's watching this video, when was the last time your rent went down? And how often are you going to sign your lease that you think it's going to stay the same or hoping that it's going to stay the same? In most cases, it goes up, especially over the last few years. So it is something where I still think getting into home ownership is better. Maybe you got to settle. Maybe you got to find something smaller. Maybe you got to commute a little more, move outside of the area a little bit. I mean, every area is going to be a little bit different. But I think if you just wait till it's perfectly affordable in town, you're going to wait yourself out of existence and your rent's just going to keep going up with nothing to show for it. No appreciation, no tax benefits. It's just better to get into home ownership when you can. Now, there's a time and place to rent. I totally get it. But it is something where I think people wait too long or try to maybe get more home than they can really do for their first home. When it's just get into it the first time, you'll make a huge difference down the road. All right, how we doing? About 17 minutes. Okay, so let's see if we can find a couple more zingers, just some bangers here. What can we find? What are the options of getting off a mortgage when the ex is refusing to refinance? So when you originally got that mortgage, you both were co-signers, so you're both equally responsible for the debt. The reason you got the mortgage is both of you were most likely on the loan. Now, even if the wife or the husband didn't bring any income at the time or anything, they're still on the loan. They signed the loan. They're equally responsible for it. It's partly a reason why you got that loan in the first place. So if they won't refinance it off, that's where you probably have to get the courts involved and force them to sell their equity or force them to sell the house or have to get them to refinance. But it's not like the mortgage is just going to say, oh, no, we'll just let them off the hook. No, that loan was approved and underwritten, designed with those two borrowers, or how many borrowers, I'm assuming two, those two were on there. So to remove them, you either have to sell or refinance. So if an ex, we're seeing this a lot where obviously interest rates were lower and people don't want to lose out on that interest rate to pay off a spouse or something like that, or cash them out or remove their name off of it. But that's just the nature of that divorce, is that now you have to untangle those finances, and part of that may be a refinance. If they refuse to do it and take your name off of it, but were awarded the home or something like that, then you're going to have to probably take the next step with the courts and force a refinance or a sell of the property. It's always ugly. When real estate's involved in divorces, that's just one more layer that adds to the ugliness that can happen with the divorce. But the mortgage company will not, in very rare cases, will a judge or anything say you have to take that person's name off that, because the original loan kind of predates the divorce. And so they'll basically say, okay, you've got to sell or refinance if able. Now, if she's not able to refinance, that's where you have to start talking about selling the property, he or she. So I hope that helps. If you are going through a divorce, I can help you with cashing out a spouse. We can do a refinance, go through title work. I can help you with any of that type of stuff. I have a lot of attorneys in town that refer me clients that are going through divorces. So if you are in that situation and need some advice, give me a call. I can kind of tell you how this works, go through your individual situation, and give you maybe some pointers on what to do next. But the long and short of it is most likely a refinance or sell. One of those two things is the most common cure to remove a spouse from the property's mortgage. You can take them off the title, but actually off the mortgage, off the credit, off that payment, so you can qualify for another house. Those are things you're going to have to deal with in that divorce situation. Let's see, we're just getting up here to the 20-minute mark. Let's see if we can nail one more. Again, if you have any questions, comments, concerns, please post them below. Let's see if we can go into a quick real estate one. That was a lot of mortgage. Let's see if I can find a real estate one. What are the advantages? What advantages do mortgage lenders offer to first-time home buyers? So there is specific guidelines for first-time home buyers. And also to clarify, if you haven't owned a home in 3 years, even if you've owned 100 of them in your lifetime, if you haven't owned a home in the last 3 years, you are now considered a first time home buyer again. So this resets a lot of things. It resets bankruptcies and judgments and other things that can be on the credit report, job histories, things like that can reset under the guidelines of first time home buyers. So there is benefits to help people that need a little help with first time home buyers, but I've had many clients that are first time home buyers and don't use first time home buyer programs. They don't need it because their credit scores aren't lower or their job history is good or they have a down payment and kind of don't need some of these first time home buyer programs. So part of my job is to sit down with the client and say, okay, is it better to do a conventional loan or an FHA? Is it better to do this first time home buyer grant, or is it better to do this or that, or do they even qualify? A lot of first-time homebuyer grants and down payment assistance programs do have income restrictions or property location restrictions. So that's part of my job, is to kind of know when a client walks in, what are some of the available programs that'll fit their needs and try to give them as many options as possible so they can narrow down which one makes the most sense. Sometimes it'll be a higher rate, but cheaper mortgage insurance, or vice versa. So part of my job again is just see which one, what the benefits and disadvantages are both. But I have a lot of people think, well, I'm a first time home buyer. That's the only program I need. And no, sometimes it's better just to go with a traditional loan. I think we're out of time. Is there one real quick? Let's see. Here's a quick one. Uh, how can private mortgage insurance be canceled without refinancing a home loan? So if it's an FHA loan, you cannot get rid of the mortgage insurance unless you initially put 10% down, which nobody does on FHA. I don't think I've ever seen an FHA loan with money down more than the minimum of 3.5 or even 100% financing. So very rare. But if you did put 10% down with FHA, you can get rid of it after 10 years. So FHA, most cases, can't get rid of the mortgage insurance until you sell or refinance. With conventional loans, it does depend on the mortgage insurance company, but almost all of them, you have to keep it at least 5 years. Then you don't have to keep it past 10 years. So you have kind of this window of 5 to 10 years. Many of them, however, will not go off a new appraisal. Unfortunately, a lot of them have built it into their guidelines where you wait the 5 years, get a new appraisal, show you have the 20% equity. And ironically, they actually want 78% loan to value. So it's 22% equity. Why that number's out there, that's just the number that they've used. Ones with the gold make the rules. So it is something where you up to the 5 year mark, there is some things that start to open up, but a lot of times it'll go off of the current balance. So you've had to pay down extra and the original appraisal or the original loan to create that 22% equity. So I'll tell you, most of the time, it's going to take a refinance. It really is. But there is provisions that do kick in around the 5 year mark. And a lot of them drop off after 10 years, regardless of the value or regardless of how much you've paid down. So there is that if you wait that long. But you can't, most of the time, you are going to have to refinance to remove the mortgage insurance. Now, here's something else to consider. If you do not have 22% equity, but you have 10%, you can actually pay a one-time fee with the refinance to remove the mortgage insurance. So if you're interested in that, where you want to get rid of it, or maybe rates have come down a little bit and you bought the home a couple of years ago and you can save a little on the rate and get rid of the mortgage insurance, I think we're going to see a little bit of a refi uptick maybe next year on people that did get into the sevens, high sixes with mortgage insurance. And now we're starting to see maybe some upper fives, lower sixes, where it starts to make a little bit of sense to do a refi. So I think we'll see a little bit. Refis have been dead for 2 or 3 years now. So I think this will be the next little wave we might start seeing as people getting rid of mortgage insurance and maybe lowering their interest rate with some of these programs. But you don't have to have 20% to get rid of it. You can pay a one-time fee and remove the mortgage insurance. So if you're in that situation, I'd love to run the numbers for you. It doesn't cost anything. I can help you kind of see if now is a good time or if you got to wait for rates to get maybe a little lower and just kind of see what happens over the next year or so, get through the election cycle, stuff like that. There may be some things that pop up next year that might be better, but love a chance to work with you. I'm licensed in Utah, Nevada, but I can get you with somebody within our company or even other companies that are licensed in other states. Most of the ones we do a lot of states kind of west of the Mississippi. So anything in the west, we really can handle. Back east is where I've got to find who can help you. But love an opportunity to work with you in Utah and Nevada. Check out my website, ryanbolton.com. I am the Mortgage Nerd. So I hope you enjoyed the video, and we'll see you on the next one.